Welcome to the Explainer. Let's get straight to it. Right now, there's a massive U.S. military force, an unprecedented armada, positioned just off the coast of Iran. And look, this isn't just some distant foreign policy headline. It's a direct and immediate threat to your wallet.
We are talking about an aircraft carrier strike group, we're talking stealth fighters, all on high alert. And this massive military buildup, it's sending shockwaves through the one commodity that touches literally everything you buy and everything in your portfolio.
And this is the result. $71.36. That's the price for a barrel of Brent crude oil, a 6-month high, and it's being driven almost entirely by the tension that's just boiling over in the Middle East.
So why does this one number matter so much? Because if there's one thing you need to know, is that while the stock market dislikes uncertainty, it absolutely hates an oil shock. A sudden spike in energy costs acts like a massive, unavoidable tax on every single one of us, and it has the power to completely derail that AI-driven economic boom we've all been banking on for 2026.
Okay, so let's dive into the heart of this thing. To really get a handle on the risk, you first have to understand the geography right at the center of the crisis, the Strait of Hormuz.
So get this incredibly narrow passage, just 21 miles wide, is basically a single point of failure for the entire global economy. A full 1/5 of the world's daily oil supply sails right through it. And with Iran facing its worst internal unrest in decades, analysts are terrified the regime is going to weaponize this exact choke point to create an external crisis, to distract from the chaos back home.
Now, here's where it gets really interesting. There's this massive contradiction happening right now. You see, on paper, the world is swimming in oil. Major agencies like the EIA and the World Bank are forecasting a huge supply glut for 2026. That should be pushing prices way down, into the $50 range. But that is not what's happening, not at all.
So if the fundamentals are all pointing to an oversupply, why on earth are prices spiking? Well, the answer isn't in the oil fields. It's in the financial markets, where the pros are placing enormous bets on what they think is coming next.
And to see what they're thinking, we have to look at something in the options market called call skew. Honestly, the easiest way to think about it is as a fear gauge. It tells us exactly how much more traders are willing to pay for insurance against a sudden price explosion.
And right now, that fear gauge has spiked to a positive 17%. Now, the technical term is the Brent 25 delta call skew. But here's what that means in plain English. Professional energy traders are aggressively paying huge premiums for those call options. They're betting the risk of a price surge is way bigger than the risk of a price drop, because they know that a bunch of sanctioned oil sitting on ships doesn't help anyone in a real crisis.
And this fear, it's not just some abstract number on a chart, it is already triggering a violent rotation in the stock market. You might have even noticed your own portfolio acting a little strange lately. Money is just pouring out of those high-flying tech and AI stocks, the Magnificent Seven, that have dominated the market for the last couple of years. So where's it all going? It's going into hard assets. The energy sector has rocketed up over 21% this year, and basic materials are up nearly 18%. Wall Street is getting ready for a world where physical stuff matters a whole lot more than digital promises.
And here is what that means for you, on the ground. When you combine these higher oil prices with the new 15% tariffs that just hit, it could add up to an extra $1,300 in costs for the average American household this year alone.
All of this creates this dangerous feedback loop that some people are starting to call stagflation light. You've got inflation that stays stubbornly high, eating away at your purchasing power, but because it's being driven by these supply shocks, the Federal Reserve's hands are tied. They can't easily cut interest rates to help the economy without risking making inflation even worse.
So the really crucial thing now is to understand the potential ways this can all play out. Let's actually walk through some scenario planning so you're not caught flat-footed no matter what happens.
This breaks it down perfectly. There are really 3 likely outcomes here. Scenario A, diplomatic de-escalation. Tensions cool, that fear premium that's baked into the price just evaporates overnight, and oil falls back to its fundamental value, somewhere in the $50 to $60 range. If that happens, tech and growth stocks would likely have a massive rally. Then there's Scenario B, the harassment phase. This is the slow bleed, where Iran uses proxies for limited attacks on shipping. This would add a permanent risk premium to oil, leaving prices stuck in a high $85 to $95 range. In that world, stable, value-oriented companies would be the safest place to hide. And then there's Scenario C, the choke point closes.
A direct military conflict breaks out and shuts down the strait. Oil prices would immediately rocket, easily breaching $120 a barrel and kicking off a severe, immediate global recession.
Okay, so given these incredibly different potential futures, what's the verdict? What's the move according to Wall Street? Well, it's not about panicking, it's about finding the right balance.
The key takeaway, the big message here, is that this surge in energy and industrial stocks is not just a temporary blip. You should not treat it like one. The market is pricing in a real, structural shift where geopolitics is back in the driver's seat. The strategy that experts are recommending is what's called a barbell strategy. It's pretty simple. On one end of the barbell, you keep your exposure to sectors like energy and materials. These act as your hedge against a big oil shock. But on the other end, you don't abandon those long-term growth trends. I mean, after all, the huge build-out of AI infrastructure is a massive driver of demand for power and industrial equipment itself.
So what does this mean for you, practically? It means now is the time to be disciplined. You might want to consider rebalancing some of those huge gains you've had from your tech winners, build up a bit of a cash buffer so you're ready for volatility, and just make sure your portfolio is truly structured to survive the potential crossfire of these very different scenarios.
So I'll leave you with this. The smart money isn't just watching the news headlines. They are watching the derivatives market. That elevated call skew is telling a story of fear and preparation. The big question is, are you prepared for what it's signaling?